Hello.
Hey, Romeo, how are you?
Hi there. Good.
Get my video up here. Ooh, that's a bad camera. Let's switch. Let me turn some lights on. It's a hot one in Charlotte today.
Oh, yeah.
Yeah.
Also 84 out here.
Yeah, it's about the same here. Super humid. Let's see. I'm going to stop. Okay, here we go. All right, everybody, welcome. Thanks for joining. I know a couple more people are still logging in. That's a-okay. I'm gonna go ahead and introduce our speaker and get started. My name is Lisa Jordan. I am the Executive Director of the Charlotte Executives Association, so the EAC, Executive Association of Charlotte. And I live here in Charlotte, North Carolina, and I'm also the Managing Director of the IEA. So I work for the IEA board and have met many of you, and glad to see some new faces on the call as well. So welcome, everybody. If you have to jump off this call for some reason, we do record these and they'll be posted on the website.
Uh-oh. I think we may have lost Lisa. Well, that's not a good start.
Are you there, Romeo?
There, oh, you're back.
Oh, okay. I didn't know I was gone. I was just talking to myself, apparently. Okay, are we good? Are we all set?
Yeah, I'm all set.
Super. Then I'll just keep babbling then. If you have a webinar topic that you'd like to share with the IEA, I'll post my contact information in the chat, and you can always reach out to me at any time, and I'd be happy to have you host one of these webinars in the future. So with that, I see you've got your screen up. Perfect. With that, I'm going to introduce our speaker. Romeo Chicco is a CPA and the founder and CEO of PayMaster Payroll Service, headquartered in Palm Beach County. He started PayMaster over 27 years ago, and his company provides payroll processing, time and attendance, and human resource services to businesses from one employee to thousands. Romeo is a 10-year member of the Executives Association of the Palm Beaches and is currently president-elect. So without further ado, I introduce you to Romeo Chicco. Please take it away, sir.
All right. Yeah. Thank you very much, Lisa, for the introduction and the opportunity to present. This is a great topic. It's hopefully you'll get out of it some money coming into your business from the government. There's a lot of misinformation out there, and I'll hopefully answer a lot of questions. If you do have a question, feel free to throw it into the chat. I will try to monitor that as I go along. Sometimes I'll see a question, and if I know I'm going to answer it on a subsequent slide, I'll wait for that slide to come up to answer it. And hopefully at the end, we'll have an opportunity for some Q&A. All right, so I'm going to give kind of a scaled down version of this. I've spoken on this topic, and it could take hours because there's just a lot of detail. I'm going to try to consolidate it into an hour or less than an hour. So, keep that in mind as I go through these details. And we're going to cover two topics. For our folks in Canada, we're going to talk about the subsidies that are available. And for the US, we're going to talk about the employee retention tax credit. I'll cover Canada first, maybe about 20 minutes, and then we'll roll into the US. So these the topics I'm talking about are nothing new. They've been around for quite a while, but surprisingly, there are things that people do not know about. There's just I know here in the US, there's not a lot of advertising for the ERC from, certainly not from the government. So you really have to know about this or have heard about it. In Canada, there are several different subsidies. Some have come and gone, but there are still some available. And I have 3 of them listed here. They are Tourism and Hospitality Recovery Program, which, contradictory to the name, a change just recently is that it's not just available to tourism and hospitality businesses. And we'll talk about that in a moment. Hardest hit business recovery program. That's if you have a significant drop in revenue, which I believe is greater than 50%. And there's a Canada Recovery Hiring Program. You may qualify for more than one, but you should file for whichever one gives you the biggest amount. And the Canadian government gives you a great tool in order to see which ones you qualify for. And I have the URL at the top there. If you go to that URL, you'll find a button. It's interactive. You'll answer a few questions. It's a pretty quick process. At the end of that process, you will get a screen like this that will talk about or tell you which programs you qualify for. So Linda asked a question. These are just for Canada. Yes, the first half of my presentation, this is only for our Canadian folks. US will be up next. So hang in there. It is kind of interesting how Canada and the US have somewhat similar programs, and we'll see that as we go through this. But when you do that questionnaire online, it tells you what you're qualified for, and you can only apply for one, and you should apply for the one that gives you the biggest amount for that period. Now in Canada, they break up the claim periods or your claim periods into periods. They're 28-day periods, so 4-week periods. Currently, we're in period 29, so we can tell this has been going on since the beginning of COVID. The periods are important because you can only qualify for a period when it's open, and you have a deadline. So period 28, which just ended on May 7th for the 4 weeks, that period doesn't open to apply for until July 1st. So this is still an ongoing. The deadline coming up, which is just in a couple of days, is for the period of October 24th to November 20th. So if you qualified for that 4-week period, you have just 2 more days in order to apply. It's a 6-month deadline after the period ends to apply. Other than after that, you can no longer qualify for that period. There have been a number of changes that have come up both in Canada and the US. As we talked about the hospitality and tourism category, just the other month, it was opened up to businesses that are not necessarily in that category, as long as you were subject to a public health restriction restricting your business, or you had a revenue drop of at least 25%. Again, in that quarter. So you can qualify for that. And actually, when I went through the questionnaire back here and it said you qualified, the responses I provided, it said, all right, you qualify for tourism and hospitality because you were subject to a qualifying public health restriction. Another change, this one was just last month, and it is targeted towards public companies. And if you are a public company and you paid out dividends in that period, you are not eligible for that period. And the thought process behind that is if you are profitable enough and you're paying out dividends, then you really don't need the government's help. So paying out any dividends disqualifies your business for that period. So we talked about there's the different subsidies that you may qualify for. You apply for the one that gives you the biggest refund. How do you know which one? You can go to this URL. There's a link on there to click to calculate. And my suggestion is they give you two options: to do it online on the web or to download a spreadsheet. And I suggest downloading the spreadsheet because you can save it, you can come back to it, and you don't have to worry about losing your work if you're doing it on the web. One note on the spreadsheet, make sure you download the most recent one. The one that was out a few months ago had an error in the spreadsheet that would have told you may have disqualified for a particular subsidy when in fact you may have qualified. So be sure you download the most recent one in order to ensure you're working with the most current and correct. So after you know what you qualified for, you use the worksheet to figure out how much and which one is your biggest return. The next thing to do is to apply. You can apply in one of three manners. Option one, you sign into your government's My Business account. You apply right on there. You're going to provide responses that were on your worksheet. Option two is if you have a company do this for you, a representative can do it. They need to be a level 2 or 3 representative. That means they have the ability to interact with the government. Then it's not a level 1, which is just they're able to receive information. And the third option is the web form. Again, from what I've heard, option 1 is your best bet than doing the web form. So after you apply, the thing that I like the best about on the Canadian side is after you apply, it's approximately 3 to 8 days to receive the funds. You do have to wait until your period ends, and then a few weeks after in order to apply, but they turn around the funds pretty quick. You can have the funds direct deposited into your account. If you elect that, it's on the shorter end. If you don't do direct deposit and you're receiving a check, it's going to be closer to the 8-day turnaround. The money you receive is considered taxable income if you're a taxable business. The catch that sometimes gets people is it is income for the period that the money is for, and not necessarily when you receive it. So looking back to a previous slide, right now the deadline is on May 19th to apply for October and November 2021. So if you apply for that and you receive the money by the end of this month, you're receiving the money now in 2022, but that is considered taxable income for 2021. So keep that in mind. You may have to amend a previous year's tax return if it was already filed. So it's I like Canada in that it is a kind of a clear path. The government provides a lot of resources, the spreadsheet, the online tool in order to determine eligibility. It is a kind of a nice package that's managed. Unlike the US, which we'll talk about, the employee retention tax credit. I'm going to start off on showing you myths. And these are all untrue myths. But a lot of people out there think that if they received a PPP, they're disqualified, or if your business didn't have a drop in revenue, you weren't fully shut down. These are all myths, and you can qualify. And we're going to talk about the qualifications. So I put this slide in. Why all of the confusion? Why are all of these myths out there? And that is because the employee retention credit has been modified in 3 congressional acts. The CARES Act of 2020, the Consolidated Appropriations Act of 2021. This one was signed in right before President Trump got out of office. This was the act that allowed you to have the employee retention credit and the PPP. And he made it retroactive for 2020. And he extended it until June 2021. President Biden came in, and after a couple of months, he signed the American Rescue Plan Act, which extended the ERC forward. And in between these congressional acts, the IRS has put out a number of notices that, again, lead to the confusion. So here's how you qualify for the employee retention tax credit. Between the dates of March 13th, 2020 and December 31st, 2021, and I put an asterisk on that December 31st. We're going to talk about that date in a moment. Your business must have been fully or partially suspended. And I have some quotes on there that is taken from the IRS. The full or partial suspension must have limited commerce, travel, or group meetings. And a huge word, or your business gross receipts, which is your revenue, must have decreased in a calendar quarter. It is one or the other. In looking at businesses, we have seen companies where their revenue actually went up due to COVID, but they still qualify for the credit because they met a suspension rule. So an example I have is a pizza restaurant with a small dining room, and during COVID and the lockdown, their delivery and takeout and pizza sales went up, but their dining room was restricted. So they had an increase in revenue, but they met the restriction rule. So a question out there is decrease in only one quarter or all. We're gonna talk about that on an upcoming slide here. There we go. So to kind of talk about the suspension rule, because it is a gray area. It is a full or partial suspension by a government entity, and that could be federal, state, county, city, local, any government body putting out an order. And the order could affect your business hours, your capacity, how you perform your work. This is not a complete list. This is just me putting out some bullet points as to how you could have been affected. So for example, we've seen a casino that would operate 24 hours a day. And in many places, you could not have a 24-hour operation. You needed to shut down your operation as an order in order to sanitize. Again, in the casino, they had to block off slot machines and social distance. They blocked off enough machines where there was a 6-foot distance in between. The same thing for restaurants. Restaurants were not able to fill 100% capacity. They were limited to 50% inside capacity or 75%. Those are restrictions in capacity. We get a little bit more into the gray area when we talk about another business you rely on is suspended that affects your business. So for example, an attorney, a law firm that does trial work. Well, many courts were not holding jury trials early on in COVID. So that law firm is unable to perform its business based on a suspension that is affecting another business. Same goes for supplies. If you are dependent, so for example, if you're in Florida and you're dependent on a product that's coming from somewhere in California where the suspension lasted a lot longer than Florida, and you couldn't get that product, then you are meeting that definition of a partial suspension. And lastly, inability to hold group meetings, events. If you would typically attend trade shows or B2B shows, and those shows weren't operating because of the inability to hold a group event. So there's a number of suspension reasons out there. I throw some examples on here as well to many that I just covered. And not being able to perform the same type of work. So we see a lot of dentists qualifying because, again, early on in the pandemic, medical doctors, dentists, were not able to perform non-essential procedures. So for example, if a dentist does teeth whitening, orthodontics, that was considered non-essential and they were restricted to perform that work. And back then it was in an effort to preserve PPE, but still a restriction. All right, so now to answer Yvonne's question about one quarter or all quarters. The rules are different for 2020 and 2021, so we're going to talk about each of them separately. For 2020, your business must have had 100 or less full-time employees in 2019. There's some confusion around that full-time. Some people think of it as full-time equivalent or total employees. It is literally, you count the employee only if they work more than 130 hours in a month. They're counted as full-time. So we saw a hotel with over 150 employees. When we went in and actually counted their employees, we found that they had less than 100 full-time and they qualified. The business must have been suspended, or the gross receipts must be down by at least 50% in any quarter in 2020 compared to the same quarter in 2019. So the period you qualify for, if you're qualifying under a suspension rule, it's for the length of time the suspension is in place. So we talked about dentists. Here in Florida, our governor, I believe, restricted non-essential surgeries and dentists from about March 18th to about May 15th. So for that 2-month period, they are considered suspended. If you're a restaurant, and again, looking at Florida, if you're in Palm Beach County, Florida, restaurants were restricted also from about March 18th through September 26th. In California, I believe the restaurant suspension went on until 2021. I think it was maybe even March of 2021. So you qualify for that period. You are affected by that suspension order. On the gross receipts test, you qualify calendar quarter. So you compare the calendar quarter in 2020 to the same quarter in 2019. If you had a greater than 50% drop, which is a pretty steep number to hit, you qualify for that quarter from start to finish. So if you, had a 55% drop in the second quarter of 2020, you qualify from April 1st to June 30th. Now, you may have also been affected by suspension order. Great, you can meet both qualifications. You just double down, but it's either or. So we saw many businesses that were affected by the suspension order first, and then they continued to qualify based on their revenue was down. On the revenue decrease, you begin to qualify when you hit that 50% in a quarter. You continue to qualify as long as your revenue is down by less than, or I should say more than a 20% reduction. So for example, if second quarter, you had a 55% drop, third quarter, business came back, but you had a 23% drop, you still qualify for that third quarter. You get to qualify for one more quarter after you recover. So what that means is, let's say for the fourth quarter, you now made a profit. You're now up to 10% over. You did better in the fourth quarter. You would still qualify for the ERC for that fourth quarter because you get one quarter after your drop. So in that example, if I had a 55%, 23%, and then I made money in the fourth quarter, you qualify for all four, or sorry, or all three quarters, second, third, and fourth. The amount you qualify for is based on how much wages you paid to your employees. And the credit is 50% of the wages, up to $5,000 per employee for that year. So still a significant amount, but we're going to see on the next slide, 2021, it exponentially increases, but still a nice credit. If you have 10 employees, you can get up to $50,000. So it is, definitely something to look at. (2021), it actually becomes, I think, easier to qualify. Right off, you can have a larger business. You just need 500 or less full-time employees. So whereas if you were over 100 for 2020, you may not have qualified for that year, but now for 2021, the look back is still 2019. So they're looking back at a pre-COVID year to check your employee count. You can still use the suspension rule, again, full or partial suspension, or your gross receipts only needs to be down by 20% for any of of the 3 quarters in 2021. So we have seen many businesses that, didn't hit that 50% drop in 2020, because that is a big chunk of business to lose. And maybe they only lost, 25% of their revenue, and it's just consistent. So there's a number of businesses that did not qualify for 2020, yet they will qualify for 2021 on that 20%. There is a little, and that the revenue drop is 2021 compared to 2019. We're looking back at a pre-COVID year to determine your revenue drop. This is a little known trick, but this is written into the text that for 2021, you can look back at the previous quarter to see if you met the 20% drop for that quarter. So that allows you to look at the fourth quarter 2020 to see if you had a greater than 20% drop in revenue compared to the fourth quarter of 2019. And that will qualify you for the first quarter of 2021. So in essence, the way to look at this is if you had a 20% or more drop, or actually more than 20% drop in fourth quarter 2020, or the first 3 quarters of 2021, you will qualify based on that revenue. The credit amount, the amount you'll get back, is 70% of wages paid per employee, up to $7,000 per employee per quarter. So this credit is available for the first 3 quarters of 2021. That is up to $21,000 per person that you could be eligible for. So again, 10 employees, that could be $210,000 plus the $50,000 from the previous year you may have been eligible for. So it is a significant amount. We have seen credits go into the millions of dollars. So it's not unheard of to see some very large amounts come out of this. There is one more credit, and I should have said this on the previous slides. In order to qualify for the ER, and actually I'll back up here. In order to qualify for the ERC, or really PPP for that matter, the US government drew a line in the sand and said, February 15th, 2020. They say, if your business opened after that date, you knew what you were getting into, therefore you're not eligible for any COVID benefits. You couldn't take out a PPP loan, and you're not eligible for ERC. Your business had to have been in operation prior to that date. In March, President Biden threw in a piece of the employee retention credit called Recovery Startup Business Credit. And what his intention is to promote businesses to get back in business, to start up. So your business must have began operation after or on February 15th, 2020. And this is geared towards smaller businesses. They are looking for you to have less than $1 million in annualized gross receipts. So if you're in business for 6 months, you take your revenue for those 6 months and you double it, and that's what your annualized gross receipts would be. Again, it's a nice amount that's available to a new business. And there is no other qualification other than your business opened on or after February 15, 2020, and you're a small business. just meet those two things, and 70% of the wages you paid your employees, up to $7,000 per quarter, and this is available for third and fourth quarter of 2021, up to a maximum of $50,000. So, every new business, if you know of any businesses that started out there, certainly let them know of this. I'm kind of disappointed at media. I was watching a lot of television, and nowhere did I see any sort of mention or news stories about really either one of these, the employee retention credit or the recovery startup business credit. It's almost like they want to keep it a secret. Both of these are non-public, unlike the PPP. So with PPP, you can go online and you can search a business and see exactly how much they received and how many employees they have and what it was spent on. Employee retention credit is private. It's between you and the IRS. So, there are some exclusions to this, and the theme of the first 4 bullet points on here is we talked about get back 50% of wages or 70% of wages. The wages must have been paid with your own money. And the name of it is employee retention credit. So if you paid out any severance pay, it doesn't qualify because your intent was not retaining employee, you severed the employee. There's a lot of confusion around the second point here. And again, that was because when the ERC first came out, if we all remember back to the April 2020 or March 2020, the president was 15 days to stop the spread. When the CARES Act came out, the thought was that this is a short-term thing. We only need to help businesses for 2 months. So, all right, 2 months of PPP, that's enough. ERC, you can only pick one or the other. So most people went the PPP route, didn't go the ERC route. When President Trump signed the Consolidated Appropriations Act, that made you eligible to qualify for both retroactively. This was put in that you cannot count the PPP money as your wages you spent on the employees. That's the government wages. So anything you spent with PPP money doesn't count as qualified wages. And same thing with these others. These are other wages you may have paid your employees with government money. I don't think there's any household employees on this seminar, but if you have a maid or a housekeeper, child caretaker in your home and you pay them as a household employee, they're not eligible. This was a rule that came out in, I think it was August 2021. Owners are not eligible in respect to their own earnings. And I look at that as, well, it's an employee retention tax credit. If you're paying yourself, the owner, you're not retaining employees, you're just paying yourself. So you're not going to get any credit off of your own wages. And the last bullet point on here is, I think this is to prevent fraud. They're saying, well, if this credit is here, you're not to hire all of your family members and kind of pay them in order to get reimbursed from the government. So if you are a greater than 50% owner, and it is greater than 50%, then you're not able to pay relatives. And relatives is pretty much any sort of blood relative. It's parents, grandparents, children, nieces. It's pretty extensive as to what they call family. And I just saw a message here. So there's a message about there's a gap for businesses that started in fourth quarter 2019. So there actually is not a gap. And I'll go back to the slide here really quick. So maybe the confusion is about comparing to the same quarter. So for example, let's go to here. So on the drop in revenue, let's say to qualify for first quarter 2021, you compare against that same quarter in 2019. And let's say your business started in October 2019, October 1st. You would look at that and say, well, I don't qualify. I have no first quarter income. That does not disqualify you. The way the rules state is you compare to the first quarter you are in business. So if you started your business October 1st, 2019, then you literally compare every quarter against fourth quarter 2019. You compare your second quarter 2020, third quarter 2020, fourth quarter 2020. You compare everything against that because that is the first quarter you're in business, to see if you had a drop. Now, unfortunately, what may happen is your first quarter in business, it may have been a ramp up and you may not have had a lot of business in that quarter. And you're now comparing COVID quarters against that first quarter in business. So unfortunately, you may not qualify if those other quarters are higher. But you can still qualify based on the suspension. You look back and say, all right, I didn't qualify based on revenue, but was I affected in some way by a state, county, city order? The way the credit is claimed, and it's called a tax credit, but it is a refund. What we're filing is for 2020 and 2021. So you have hopefully paid your payroll taxes for that year. So everything we're talking about is a check you will receive from the IRS. The way you claim it is you file an amended payroll tax return. I would suspect most businesses on here file a 941X, or I should say a 941. So the amended return is a 941X. You have a 3-year filing period. So unlike in Canada, where you have 6 months in order to file that for that subsidy, here, 3 years after you filed the original return. So I would hear some people out there saying, it's too late. It won't be too late until really July 2023. And at that point, you will not be able to amend the second quarter 2020 because you'll be at the 3-year mark, and that'll be just a rolling expiration. Every quarter is filed separately. With the 941X, you do not have to provide any sort of backup. Really, all the IRS wants to know is your qualified wages, the credit amount, and that's pretty much it. These are subject to an audit, and that's where the IRS is going to come back at a later time. If you're selected for an audit, and that is where they will ask for more details as to right, you said you were suspended. Let's see proof of suspension orders, or you said you had a drop in revenue. Let's look at financial information. But each quarter is filed separately. Excuse me. Unlike Canada, where the refund is 3 to 8 days after you file, here it's about 6 months, and then that's actually good news. If you asked me about a month ago, I would have said it's about 8 months on the good side. We would see some companies not get their refund for about a year. So we've seen some recent evidence. The IRS, the commissioner announced some changes. I think it was about a month ago that they are assigning about 700 agents or reassigning 700 agents. They're mandating overtime. And a long-term goal is they've put in to hire 10,000 agents. So the good news of that is more agents to process these. I think some of those changes are making an impact and getting these processed faster. On the downside, I think that's 10,000 agents that will be able to audit these in the coming years. So there's a good and bad part of that. Another little good piece is the IRS is including interest on that payment going back to the original filing date. So if we were to file a 941X today for, let's say, second quarter of 2020, they're going to include 2 years of interest on that credit, on that refund. So it's a nice little bonus you get from the IRS there. See if I had any questions. So that is kind of the end of my formal part of the presentation here. I wanted to leave some time out there for questions or anything specific. I have my email address on there. I am more than happy to answer any questions. Even though you're not one of our clients, there's a Reddit group out there. I am actively posting responses to people's questions out there. So, I'm just all about helping businesses take advantage of these little known avenues for some additional funds into your business.
Thanks so much, Romeo. I hope everyone got some good information from this. Do we have any questions?
To file this, we just file it on a 941 amended return. There's no website like with PPP or anything like that.
That is correct. If you search for the 941X, on IRS, it's I think it's a 5-page document, and on there you will find a line that is specifically employee retention credit, qualified wages, what was reported on the original return, which would be 0. On the correct return, you put the amount of the credit. You put in a reason. They want a reason for the amended return, which is, someone on Reddit had wanted to put like a whole story about their business, and I said, don't do that. That's probably going to cause more problems than you think you're solving. Just say claiming employee retention credit. So simple, straight to the point. We have filed over 1,000 of these going back to January, actually going back to April 2020. So that's all we put on those returns, and they're getting processed.
Okay. Thank you.
Any other questions?
I've got a question.
Yes.
In the IRS guidelines, it said it's in addition to the first and second calendar quarters of 2021, employers may elect in a manner provided in future IRS guidance to measure the decline in their gross receipts according to the immediately preceding calendar quarter, i.e. the fourth calendar quarter of 2020 and the first calendar quarter of 2021 respectively, compared to the same calendar quarter in 2019. I'm a little confused on that lateral movement because we didn't qualify for the first quarter. If you compare quarter four from 2020 to quarter one in 2021, we were down 33%, but I'm not sure that would qualify.
Yeah, so you can compare. So for qualification of first quarter 2021,
Yes.
you can look at fourth quarter 2020 and compare it to fourth quarter 2019.
Okay.
If you had a drop of greater than 20% in the fourth quarters, 2020, 2019, that would qualify you for first quarter 2021. It's a little bit wonky of their writing, but you can use a looking back at the previous quarter. Now, the other thing that means is, let's say you had a 22% drop in first quarter 2021 compared to first quarter 2019. So, all right, great, we qualify first quarter, we take the credit there. So now second quarter of 2021, you made money, business came back, you made money. You still qualify for second quarter, because for second quarter, you can qualify by looking back at the first quarter. So a qualification in a quarter kind of gives you that quarter plus one more. And some people miss that, or many people miss that because of how it's worded.
Yeah, that's confusing.
It's confusing.
We qualified for the second quarter and the third quarter, but not the first quarter. And we were looking at, and the fourth quarter of 2021 was not, they didn't continue it.
Right, right.
So we were trying to see if we could qualify for that first quarter, but our revenues were only down 5%, unless you compare it to the previous year, and then it was down 33%. But you can't compare it to 2020. You can only compare it to 2019.
Right.
It's my understanding. Okay.
Yeah. Everything, the look back for any year is 2019. And that's your pre-COVID years of your. To look
Okay,
back
so the qualification in quarter two and quarter three of 2021 are not retroactive to quarter one if it was only down 5%.
Yeah, if your quarter one 2021 compared to quarter one 2019,
You're right.
didn't have
Okay.
that 20%, greater than 20% drop, you wouldn't qualify. But you
Got it.
could, if you look at that fourth quarter and you had that fourth quarter drop.
I see. Yeah.
It wouldn't have qualified you for 2020 because in 2020 you needed
50%.
You needed to hit a bigger drop.
Right. But in 2020, we received the PPP funds, so we wouldn't have been able to double dip anyway.
Yeah. But the way it works with PPP is you look, you exclude that. So for example, I had a slide for a different presentation up where I gave a timeline breakdown, but let's say your suspension or revenue drop went from April 1st to September 30th. You applied for the PPP kind of right out the gates and you received your money, April 20th. Well, great. You got your PPP money April 20th, but any payroll you had from April 1st through April 19th, that's eligible for ERC. That was definitely not paid for with PPP money because that came after. So you qualify for that little sliver at the beginning. Then you receive your PPP money, let's say April 20th. And it's not when your covered period runs out, it's when the PPP money runs out. So let's say you use the full 24-week period when you file for forgiveness. But in reality, you spent your PPP money by August 31st. You went from April, you took 4 months to spend the money through August 31st. Well, that period, you wouldn't be able to call those wages qualified for ERC, but we look at after, right? From September 1st through September 30th. Another little sliver. You go, all right, for that month, that qualifies for ERC. So you pull out your PPP wages and you see what's left around it. There are some tactics to use. No one said you had to spend your PPP money as soon as you received it. So when we look at helping clients with this, we would look at, here's an example. You had a revenue drop and you qualify for second and third, let's just say second quarter of 2020. And you got your PPP money in April 15th. And you do the full 24-week period. So what most people would do is they would say, well, I only have ERC for April 1st to the 15th because then my PPP money pays the rest of the quarter. And they don't think they're going to get a lot, and maybe they don't file for a lot. But the tactic you use is you say, well, yeah, I received my PPP money on April 15th, but I'm not spending it. Instead, you say, I'm going to say, I didn't spend my PPP money until July 1st. And as long as you can spend your PPP money from July 1st until whatever the end of the 24-week period is, September, then you say that is the period I use my PPP money from July 1st until September, October. And that means everything for second quarter, I'm going to file for ERC. So you're shifting how you are saying that the PPP money was spent. So you can be tactful in that.
Okay, thanks.
Yeah, you're welcome.
Thanks so much, Romeo. This was some great information. We are at the top of the hour, so if anyone has to go, totally understand. Romeo, are you able to stay on for a minute or two more and answer any more questions?
I can, sure. And again, my email is there. So if you think of something after the fact, I'm happy to answer questions for you.
Perfect. Yeah, that sounds great. And there was a question about the recording that'll be available usually by the end of the week on the same link where you registered at ieaweb.com under the webinars. So thank you so much for giving of your time today and hosting this webinar. We greatly appreciate it. And we'll see everyone at the next one. Take care, everybody. Bye-bye.
All right, bye-bye.
Bye, it was nice to meet you.
Yes. Bye, Yvonne.